Good morning, everyone. So today, as scheduled, we are going to discuss evaluation of mutual funds. What are the factors and how we differentiate between different mutual funds, how we identify which fund to select. We have discussed some of this in our previous sessions, previous webinars also. But today we are going to dig a little deeper into the mutual fund universe and try to find the factors which can help us identify a better mutual fund or a better performing mutual fund from the whole universe of different types of mutual funds. So let's dig deeper and let's see what we are going to do today. So we'll have a brief look at all the selection criteria for mutual funds, and then we start analyzing the mutual fund criteria one by one. We also will also see what types of mutual funds are there and different types of fund objectives, how they affect fund performance and fund evaluation. And then finally, some numbers, uh, or you can say different types of numbers, which will give you an idea what kind of mutual fund you are getting into. And before we start digging, just a disclaimer. If you see or hear any brand mentions in this webinar, it's not a promotion, it's only a coincidence and only to improve the presentation that is there, but it may or may not relate to your situation. So if you want a specific customized solution for your situations, your financial scenario, please contact with your financial advisor, or you can drop us an email at the end of this presentation. So the old adage, as we adhere to it, know your enemy and know yourself. So in all our previous sessions, we have been trying to know our goals, basically trying to know ourselves. This is one session where you are trying to know your enemy, or in this case, let's see the external factors like mutual funds, or this this is going to be applicable to everything. So know yourself is knowing your financial goals, your financial situations, your incomes, cash flows. Knowing your enemy would be in financial scenarios, knowing where you are putting your money, where you are investing, which financial products are you using to grow your money, to safeguard your future, and so on and so forth. So today is the session about knowing your enemy or knowing the mutual funds. And as we go forward, so this leadership principle is all about managing risk. And almost every investment is about managing risk. So usually risk management refers to what you call as insurance management also, but insurance is going to manage a kind of risk, which is not in your control and which doesn't, and if that risk does not happen, so it doesn't increase your chances of uh, growth. But the risk that we are going to talk about today is if you can manage these risks, you can grow your wealth, grow your money, grow in prosperity and all. So this is more like an investment risk we are going to talk about today. Let's see. So when we select a mutual fund scheme, we look at quite a lot of things. One of those things is investor's risk profile, that is your risk profile, and time available. And once we have all this information, your risk profile will depend on your income, age, occupation, financial goal, your current financial situation, and then how much time do you have available. So how we are going to use this information in selecting mutual funds. So once we have this, we can go ahead and start selecting mutual funds based on their different risk profiles, and we'll create a portfolio which adheres to your risk profile as an investor. So what are the factors that will help us decide or choose a different type of mutual funds? So asset class is one of the major factors, and you already it's very easy to understand. If you are investing in equity, equity is considered high risk. You can invest in gold, you can invest in debt securities, bank FDs, or corporate bonds. Then there is a type of fund. So type of fund will dwell all these pointers and details. Management style, objective of the fund, benchmark, which type of benchmark. If you don't have any other information about the fund, you can look at the benchmark they are following, and that will help you judge the risk profile of the fund. And I'll show you how that happens in a while. Performance analysis is what we look at the returns of long-term returns and everything. So, and finally, there are financial ratios, and there are quite a lot of them. So, we'll have a look at the most important financial ratios and how you can interpret them. You can find, you don't have to calculate most of these ratios. You will find the numbers already calculated if you search on the internet. Go to reliable sources, and you can look at these numbers. Even mutual funds information documents said, and they also provide these ratios, most of these ratios. Let's move on to the first one, and let's look at the asset classes. Or asset classes are pretty clear, so we'll get into that later. These are the types of different mutual funds. So there are open-ended mutual funds, there are closed-ended mutual funds. Open-ended means you can enter and exit the mutual fund at any point of time. There is no, so you will buy mutual fund units from the fund itself, and then you can sell the units back to the fund. You don't have to go to exchange to or some other investor to dispose of your units. Then there are actively and passively managed funds. Actively managed funds are those where fund manager is actively involved in selection, purchase, and selling decisions of the securities. Passively managed funds are those funds where portfolio once created remains pretty much the same till the end of the fund's life. These funds are, for an example, there is index fund. So an index fund follows the index portfolio. If there are 30 securities in the index, those are the only 30 securities the index fund will also have. And as the index changes, the only when the index faces some change in securities, so some securities will go out of the index, some other securities will be added to the index. Only then the index fund will make any change to the portfolio. Otherwise, there is no change. So that's how index fund becomes a passively managed fund, because the fund manager doesn't have to actively make any investment decisions. The rest of the funds will be actively managed, and so in that sense, passively managed funds are a little less risky because there is a benchmark which is being followed, and that defines the risk of the portfolio. There is no human angle to it. And then there are different types of funds based on investment objective. So investment objective can be of different types. Like most common are growth, income, and liquidity. So liquidity, if you go for a money market fund, you know that you don't know if you will need the money within a week or within 2 weeks. You park the money in a liquid fund, and you can withdraw that at any point of time. It comes back into your account within a day. So T+1 is the settlement period for that can do these kind of funds. But other funds which are equity oriented schemes can be growth oriented, which are not going to pay any dividend, but which will reinvest any earnings they have and try to increase your capital value. And then there are income schemes which will try to distribute the earnings uh, quarterly or annually. And then asset portfolios. So these are So equity funds, debt funds is one asset-based funds. But if I want to have a fund which has a portfolio of equities, debts, and other asset classes, then I can look at hybrid funds or I can go for alternative investment funds. And these funds will have multiple different types of assets within uh, their portfolio. And then there are thematic and solution oriented funds like tax saving, retirement, uh, child welfare, arbitrage. There are n number of categories and they can be created. There are value funds, there are uh, contra fund, there is financial services fund, and then there are exchange traded funds. Exchange traded funds are slightly different from other mutual funds. These are available on the exchange at any point of time for liquidation, and they can be actively and passively managed as well. So these funds are available usually as a stock. Just like you can buy the units in these funds, just like you buy equity stocks from the exchange and sell them right there itself. Then there are overseas funds. These are the funds which are going to invest in overseas assets, overseas securities, real estate, or other investment modes. And then there are fund of funds. Fund of funds are basically managing different other mutual funds, and they can have a lot of themes. One of the most common themes is gold and international fund of funds, which are going to invest in US or uh, European countries or NYSE and these kind of exchanges. They give you different exposures, and based on their asset class, what they are holding in their portfolio, you can determine risk in these funds. So, what kind of asset class you can expect in a mutual fund portfolio is usually these. There can be others, but in India, most common asset classes are equity, debt, real estate, gold, other mutual funds, and commodities. So there are commodity oriented funds as well, and have you can invest in these funds which are managing commodity funds. Now, objective is one of the different unique things. If you can understand the mutual fund objective, it can give you a direction in which you need to look at to assess the mutual fund risk. So, if the fund is growth oriented, you know that if your investment horizon is 5 years, there is no cash flow as per from the fund. There is no automatic cash flow coming from the fund. You will be staying in the fund for 5 years, and it will give you capital appreciation. At the end of the 5 years, you should have a capital gain, substantial capital gain. Growth funds allow compounding growth to your money because you are not withdrawing the funds. They are not distributing the earnings that they have. They are going to reinvest those earnings in the same similar securities they have been earning from. So the return from growth oriented funds is going to be completely linked to the securities that they are investing into. And then there are investment style funds with a different investment style. They follow that unique investment style. Some funds are contra funds. They are buying when the markets are trending downwards, and they are selling when the markets are trending upwards. And there are multiple similar investment strategies these funds can follow. So investment objective will define that strategy for you so that you can for transparency purpose that this is the way the fund is going to invest. And investment strategies obviously decide the overall risk profile of the fund. Income distribution funds are going to, you can say, they are less risky. You can consider mathematically, you can consider them less risky. If you are investing the income that these funds are generating for you, you can invest that income in lower risk assets like bank FDs or debt funds. So automatically your overall portfolio risk gets reduced. Then there are capital protection funds. So capital protection fund will offer uh, protection for a certain percentage of your capital. Let's say 80% of your capital is protected. So no matter, regardless of the market returns, whether the market is giving 50% negative returns or 50% positive returns, your 80% of your portfolio value will be secured. It is guaranteed to return back to you. Some other capital, so 80% I'm just taking as an example. There could be 100% guarantee as well. But uh, if the fund is investing in a risky asset class like equity or gold, they will offer slightly lower capital protection like 90% or 95%. And then there is risk reduction and return maximization. These are the most common objectives of the fund, even if they are not written as a fund objective. Every fund tries to reduce the portfolio risk by adding securities which are more manageable or where the risk is uh, slightly lower, or they are canceling out each other's risk. Return maximization. But if the fund is defining very clearly that the objective is risk reduction, for example, in a diversified debt fund, if risk reduction, lower risk is the objective of the fund is trying to invest in securities which are going to be offering less volatility, like gilt securities, shorter duration securities. And if the fund is vying for a maximum return, they are trying to include securities which are going to be highly volatile, and there is a possibility of higher than market returns in these securities like value stocks, low PE stocks. And then there is portfolio style. So portfolio style is the diversification of the portfolio, whether the fund is holding 30 securities, 25 securities, or it is holding multiple different types of assets in the same portfolio. And then there is long term and short term. So if this is the duration, so long term, short term usually matters most for the fixed income securities. So debt funds are mostly affected by this. If you are investing in a short term income fund, short term debt fund, it will offer lower risk. And a long term debt fund which is holding long term securities is going to be offering more risk, and definitely you are going to expect more higher return from this. So one thing that we need to remember at all the time is the higher the risk a fund is offering, the higher the returns also should be there. So whatever risk you are taking, your returns will be accordingly have to be accordingly high or low. So, and this is where all the other factors come into play. So if especially in the case of uh, a new fund which has just launched and does not have any performance data, performance information, past performance, benchmark becomes the most important factor, most important data point to judge the risk factor of the fund. Although the mutual fund will declare the risk profile of the fund in the fund information documents, scheme information documents, but if you want to understand it better, it's benchmark is the go-to parameter where you can look at and easily judge the volatility and other factors of the fund. So as you can see, this is an equity fund which is following an index. It's a passively managed fund. ELSS. It's a tax saving fund, and it is following index as uh, benchmark index, and the fund return is slightly lower than the benchmark. So they have similar risk profile, but the fund return is lower than the benchmark. Similarly, you can find other funds which will have a slightly higher ROI than the benchmark. and that's what we want: more return, lower risk. And so fund performance is one of the most common factors which almost everybody gets to look at, and this is the easiest to judge factors. So you are looking at trailing returns, 5 years, 3 years, 10 years, and you're trying to compare it with the other funds. But that is just the start. That is a good place to start, but that is not everything. There is more to the fund performance than just the number that you see in 3 years or 5 years or 10 years performance. So, two funds can give you the same kind of return, like 21% each for 3 year period. They have generated a CAGR of 21%. Now, how do you judge which fund is better? For that, let's move on to the financial ratios. So there are eight major and most popular ratios, which almost every fund manager, every mutual fund advisor should be looking at while selecting the mutual funds. So return alone is not enough to judge a mutual fund performance. You also look at the risk that you took. So if one fund is more risky but giving the same return as the other fund, which is less risky portfolio, there is something wrong with it. And obviously, the less risky portfolio is better because it offers you more confidence that you will achieve that kind of return in future also. So, what are the factors? Standard deviation is one which is available for almost everything. Duration is available for bond funds or fixed income securities. Jensen's alpha will be available for both. Beta, yes, Sharpe, Sortino, Treynor, and information ratio. So we'll look at each of these ratios one by one, what they mean and what they indicate. First thing, let's have a look at the standard deviation. So standard deviation simply shows you how volatile the security performance is. So on the left, you see the small cap fund over a period of 6 months, almost a year. It's about 6 months. So over a period of 6 months, you see the return has gone from 0% to minus 6-7%, and from that to 10% also. A very volatile performance. But on the left side, you have a money market fund, which is pretty consistent with the return. It continuously starts going from 0% to 4%. But if you compare, also there is less volatility, more assurance that your money is going to grow, but the rate of growth is going to be low with the money market fund. With the small cap fund, there is a possibility that your investment may be reduced in value over a very short period of time. But if you look at the long term growth, it is giving you 30%, almost 30% growth from the starting point. So standard deviation is the number that represents the volatility. So the higher the standard deviation, the riskier the asset. The lower the standard deviation, the less risky the fund is, less volatile the fund returns will be. But obviously, if volatility is low, you can expect that future long-term returns will also be lower, or may not be. Let's see. For fixed income securities, we also look at duration apart from all those ratios. So duration, what it represents is how quickly you can recover the money that you have invested. So let's say you buy a bond worth rupees, a bond with a face value of 1,000, and you buy it like 5 years before the maturity. So you might be spending around 700 rupees or something to buy the bond, depending on the market interest rate. And then there is a coupon rate also associated. So whatever cash flow you are getting, plus there will be a face value 5 years down the line. So with these coupons and face value and all the cash flows, how long will you take? How long will it be before you can recover the money you have invested based on the market rate of interest? So the longer the duration, the riskier the bond is considered. So a bond portfolio will also have a duration, and you need to look at is whether the duration is matching your investment term or not. And duration is two types. There are two types of durations. One is Macaulay duration or general duration, which is uh, mentioned in years. So usually the bond duration should be lower than the maturity period of the bond. And there is a modified duration. Modified duration tells you how volatile the bond is going to be if the market interest rate changes. So higher modified duration means higher volatility and higher risk with the bond. Then one of the most important ratios is Jensen's alpha, also simply called alpha. So this alpha shows you the excess return of the folio. So this is the ratio which gives you, we were talking about the risk versus return possibility here. So if your portfolio is taking, has a standard deviation, has certain standard deviation, which is going to represent the risk in the portfolio, and you have a benchmark, uh, you have a risk-free return also. If you did not take any risk, what would be your return? Let's say you put all the money in the savings account or money market instrument, you earn 5%, 6% on the money, and then you invest in a security which has a standard deviation of 12. So the excess return is there should be excess return. If the risky security also gives you 4%, there is no point of taking risk. So there should be excess return, and that excess return for every unit of the risk that you took is represented by alpha. This is also called fund manager performance often, but it's only simply showing you the excess risk that you receive for every amount of excess return you receive for every amount of risk you take. Obviously, this number, the higher the number, the better. And yes, it has to be positive. So when you're comparing two funds and you're looking at alpha, the fund with a higher alpha has to be better performer. But that's not the only thing. Let's move on and let's see there are other factors also. Beta is another factor which represents the relationship of the portfolio with the market. So if market is rising 1% in a day, how much the portfolio value is changing? That's represented by beta. And a higher beta will obviously represent a portfolio that is more volatile than the market. So for alpha calculation, we were benchmarking our return based on risk-free rate. Risk-free means risk is zero. There is no standard deviation. But for beta, we are benchmarking based on the market return. So if you are investing in equity mutual fund, you will base your calculation, your performance analysis on the Nifty 50 or BSE 30 performance. And this is where beta comes in, and beta will show you what is your relative performance with the market. So if market is rising 5% in a month, how much your portfolio is changing? If it can change more than the market, it can change less than the market. It can also change in the opposite direction. So one parameter of judgment, the higher the beta, the more the risk. Also, if beta is zero, that means there is no relation. Market can move anywhere, and your portfolio is going to move in a different direction. So you can't judge the portfolio performance by market performance. Then there is Sharpe ratio. Sharpe is uh, basically judging the opportunity cost. If you took a higher risk, how much excess return you are getting. So if two funds have similar standard deviation, you need to look at Sharpe ratio to judge which fund has performed better. The fund with a higher Sharpe ratio will be a better performer than the is expected to be better because all these ratios are based on historical data. So this only gives you a picture of the fund consistency and what you can expect out of the fund. Majorly, these ratios are useful for judging the risk associated with the fund. Return is something that none of these ratios are going to predict. You can create, there are statistical models you can create to predict the returns, but there is never a certainty of the returns in mutual funds. All these ratios are again based on historical data, so they are based on something that has already happened. There is nothing that can change that, but it is no guarantee of the future performance. So keep that thing in mind while analyzing your portfolio. Again, Sharpe ratio also, the higher the better. Then there is Sortino. So Sharpe ratio, all the fund managers and everybody, mathematically sound people, looked at Sharpe ratio and said, okay, uh, there is a mean average return over a period of time, and then there is high movements which are higher than the average, and there are movements where the returns are negative. So how do we judge for every negative? So risk is you don't want to take negative, you don't want negative returns. So that's the only risk you have. But you want positive risk, so positive returns. So positive movements are not the risk. So they eliminated the positive movements and they only took the negative side of the portfolio movement, and then they use that number to judge how much excess return the portfolio is generating for every negative movement. So another form of another version of Sharpe you can say, but this one is also more scientific and more accurate because it's only considering the negative moments and discarding all the positive. So if your Sortino is also positive for the portfolio, you can be even more confident of better performance in the future. After Sortino, there is Treynor ratio. Treynor is so in the previous Sharpe ratio and Sortino, we were judging the performance based on standard deviation. Treynor is going to judge the performance based on beta. So Treynor is basically considering that you are anyways a equity market investor. So uh, what you are judging the fund performances is out of your own performance, which you could have done without any fund manager. You could go to the stock market and buy these stocks. So if the market is performing certain way without the fund manager and you are generating that kind of return, why not judge the fund performance based on, and you are trying to see whether outsourcing this investment to a different person will be more beneficial. So that's what you judge with Treynor ratio. So it is going to judge the excess return that portfolio generates over the market based on for the market risk, that is beta, and obviously the higher the better. Then there is also information ratio. Information ratio is another reliable indicator of the fund performance, and this is also giving you an idea how the fund performed against the benchmark. So obviously, from the benchmark, you want, if the fund is actively managed, or even if it is passively managed, you want a positive difference between your fund returns and benchmark returns. So one is exceptional in case of Sortino. Obviously, it should be positive. Negative ratio is negative marking, less than optimal fund performance. But what you're looking at is something between 0 and 1. And to conclude, this is how the fund distribution looks like for different investment horizons and different investment risk profiles. So if you're a conservative investor, we might be looking at an aggressive hybrid fund for you if you're investing for 10 plus years. But if you're an aggressive investor, if you have an investment profile of an aggressive investor, you can include small cap and flexi cap funds for 10 plus years of investment horizons. Thank you very much. This was all for today. And you can post your questions on these credentials, and we'll try to get back to you as soon as possible. Thank you very much. Have a nice day. Bye bye.